The relentless precious metals rally that we have witnessed since August 26th, that's taken gold up $1,000 in value and silver to new all-time highs, finally went into a profit-taking correction on Friday, October 17th, 2025, the day I'm taping this new gold market commentary. We've also seen the silver squeeze that reared its ugly head up in London last week in the London over-the-counter market ease a bit this week, but not much. In this gold market commentary, we'll drill down on the latest charts for precious metals and what's happened to ease the silver squeeze in London a bit in the past week. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. If we can help you with any of your needs in the physical precious metals arena, whether you're buying or selling, we'd be honored to have that opportunity. So let's get on with our update. Since the London silver squeeze erupted a week ago Thursday, we've seen the premium for physical silver in London surge over that in New York. And that's drawn a lot of silver out of the COMEX warehouse and elsewhere back into London, which is helping to ease the squeeze a bit. We've also seen the silver lease rates, the cost of financing, and the physical premiums that they've been paying in London ease a bit, but they're still abnormally high. And what's contributed to this squeeze? Well, record silver demand, primarily in the form of ETFs around the world, in particular India. We've seen refinery hedging also have an effect. Over the last 2 weeks in particular, speculators have ramped up their long positions in the COMEX exchange in New York, which led to today's profit-taking correction. We've got silver refineries backed up, creating a real bottleneck, which is causing some further dislocations because we've seen carrying costs for silver surge for the time that the silver's stuck in the refineries that we all have to pay. Because we're not getting reimbursed until the refineries actually process the material. So that's making bids drop a bit, especially for the lower purity items like junk bags of 90% pure silver or sterling silverware. In the meantime, this incredible rally, particularly for silver, has seen physical demand for silver in the US ramp up substantially, 5, 6, 7-fold over where it was just a month or two ago. And many of the mints around the world have been caught with their pants down. They're not prepared for this wave of demand that we've just seen. So we're seeing premiums edge up a little bit and some delivery delays starting to percolate into the physical silver market. And on top of all that, the COMEX today, Friday, October 17th, raised their holding margins on gold for contracts to 5.5%. And for silver, 8.5%, which helped to contribute to today's market sell-off in New York. Because suddenly, if you've got positions, you've got to pony up more money to hold those same positions. So that's helped to contribute to today's sell-off. I'd like to take just a moment to go through how the silver squeeze developed. And it's primarily a lack of physical availability in the London over-the-counter market, where demand simply overwhelmed available supplies, creating a sudden rush for everyone to buy whatever they could get their hands on, causing premiums to spike and financing costs to surge as bankers who finance these trades saw enhanced risks. So they wanted a greater premium to take on that risk because there was not enough silver around to cover what people were trying to buy. And it's illustrated most clearly in this graph that I got from the mining stock article that I'm referencing here on the screen from October 11th. This is a graph that shows how much physical silver is available in the London Bullion Market Association warehouses, but it's not quite the whole picture. The white line shows the total amount of silver. The blue line shows what's available for over-the-counter deliveries. The difference is what's held by ETFs that is not available for immediate delivery. As you can see, over the last couple of months, the amount of ETF silver has gone up compared to how much available silver there is has gone down. And that's helped us put the squeeze on, creating simply more buyers than available ounces to be bought in London, which broke the market a week ago Thursday. And that's all been compounded by how much physical silver has moved into the COMEX over the last year due to fears over potential tariffs on silver. Let's take a look at what's happened in the COMEX. This chart shows how many ounces of silver are available in the COMEX warehouses. There are 9 of them, major warehouses, going back to 1994. For most of that period, there were under 200 million ounces of available physical silver. Then starting in about 2016, that ramped up to 300 million. And then going into COVID, it peaked at 400 million. And that was when there was a legitimate need for a lot of physical silver because silver demand exploded on the back of the COVID outbreak here in the US. And that's how it got sold down back to about 300 million ounces, actually about 280 million ounces before President Trump was elected, and the fear of tariffs created a higher premium in New York than there was in London for physical silver over tariff fears, which drove over 200 million ounces of silver from elsewhere into COMEX warehouses. Now let's drill down on a 1 year or a year to date chart to see this in a little bit more clarity. The amount of physical silver drawn into the COMEX warehouses at first peaked in April, right around Liberation Day, at just over 505 million ounces. And then we held pretty steady at just over 500 million ounces going into the last couple of months, where we've seen it edge higher again because the Trump administration still has not done a strategic mineral review called 232, which might or might not put tariffs on silver, platinum, and palladium. So the amount of total physical ounces of available silver in the COMEX warehouses peaked on September 26th at 531 million ounces. But in the last 2 weeks, due to the silver squeeze, we've seen that drop to 512 million ounces as of yesterday, which means 19 million ounces has migrated out of the COMEX, and we're assuming it's gone back to London. So this is part of the squeeze problem. Too much silver in New York, not enough in London. Problem number one. And what the squeeze caused were for lease rates to spike. That's a financing cost when you want to borrow silver that you're going to replace in a week or a month or 2 months or 3 months. It's the rental fee. They spiked to abnormally high levels, close to 40% on a monthly basis, and now they're easing. But we also saw the premium, what dealers are willing to pay over the COMEX contract price, spike to as high as $3 at one point in time, routinely at about $2.20. And now that has eased a bit as well. So while the squeeze is easing, finance rates and premiums in London are still abnormally high. So today we're seeing the premiums in London about $1.40 an ounce over New York, which is still high. And the monthly lease rate on an annual basis has dropped from about 150% down to 40% on an annual basis. That's still high. We're seeing longer term lease rates, 1 to 3 months at 20%, 6 months at 15%, and 1 year at 7%, indicate that the market thinks that this situation will normalize over time. And we tend to think that that's what will happen too, but it's going to mean a lot of silver is going to have to satisfy that demand in London. We've already seen 19 million ounces leave the COMEX. But according to one of my friends, who's extremely well placed in the marketplace, Robert Gottlieb, a former JP Morgan Chase trader, Robert believes that it's going to take over 100 million ounces of silver to normalize this situation, which means it's going to take time. And who knows whether demand will continue to stay abnormally high in the meantime or not. We don't know. So this situation is going to go on for a while. It could get better or it could get worse. We don't know yet. But we are going to have some physical silver issues going forward. And this is how I see them. As one of my trading partners said the other day, there's a lot of silver. It's just in the wrong place, in the wrong form. And we've illustrated that already. But the second place where silver is kind of like a pig in a python, like the COMEX exchange right now, are refineries that have become a major bottleneck for physical silver. Many of them are backed up 2 months processing the silver that's already been delivered to them. Some are refusing delivery. Some are refusing lower grade silver that takes longer to process or to purify, like 90% junk bags, or sterling silver, which is 92.5% pure. And what this backlog is doing is it's creating cash flow issues and financing carry cost issues for dealers who have silver in the refineries. Normally, you send it in, it gets processed in a timely manner, you get paid. Now that's causing a whole dislocation in dealers' cash flow, which is causing bids to drop a bit. Because if you're not going to get paid for a while and you've got to borrow money to cover that, in the meantime, you've got to cover those carrying costs. So there's a whole nother pig in the python, which is the refineries right now. Now, that'll ease over time, but again, it's an issue right now. In the meantime, it's that time of year where sovereign mints roll over from the current year to next year's issue. So there's some hiccups in the supply for sovereign minted 1 ounce silver coins from the British Royal Mint, the Austrian Mint, the Royal Canadian Mint, the South African Mint. But the problem is especially acute with the US Mint. The US Mint normally doesn't roll over production until late November or early December. Well, this year they decided to do it early. Oh my God. So they're going to create a strain in the marketplace for silver eagles. There's not many 2025s left anywhere. Fortunately, we've had a lot of sellers, so we're able to self-supply with some backdates. And we actually bought a tranche of 2024s last week, seeing this problem ramp up. So we took a position from a dealer that did have excess 2024s on the shelf. But in the meantime, premiums for sovereign minted silver coins, in particular, silver eagles, are going to be higher than normal unless you can get backdates at a more reasonable price, which we have available right now. And if that's the case, the premium gets too high, then you can roll over into the Maple Leafs or the Philharmonics or the Britannias that are, nearly as popular. They're still an ounce of good silver, but there are going to be some modest premium increases there and perhaps some delivery delays as the mints try to play catch up to the demand wave that has hit the market. In the meantime, we're still waiting for the Trump administration to release their 232 strategic mineral reserve information, which could come Sunday, October 19th. I'm taping this on Friday, October 17th. So by the time you see this video released on Monday, the 20th, we may know what that strategic mineral reserve review is going to say, whether silver, platinum, or palladium might actually be tariffed or not. We don't know yet. And that could have a big impact on these markets going forward. We just don't know yet. So let's get into our charts. I'm going to start with silver because that's had the most interest of late. This is a 1-year silver chart that shows, despite today's price correction that took the silver price down about $2 an ounce, we still have a 57% 12-month rolling gain in silver. And this has been a moonshot over the last couple of weeks, as you can see. Incredibly strong market price based on global physical demand and ETF demand, particularly out of India. I've seen that one of the ETFs in India has stopped buying silver until premiums in London come down to more normal rates. So if we do get some normalization in rates in London, we could see demand continue to spike right back up again out of India. Who knows? But the market's got a lot of variables going on right now, and things can change quickly. So anyway, here's the 1-year silver chart. Let's go down to a bit more granular level for the 6-month candlestick chart. And just last week, I put those three green support lines off to the right when silver was just barely breaking $50 an ounce in our last update a week ago. And now we've seen silver go all the way up to 54.50 this week and now enter into that price correction. So what's really happened in the last 2 weeks with this big move higher is speculators in New York on the COMEX exchange have gone long December silver contracts and other futures months. And as the price has moved up, they've gained equity on those positions, which has allowed them to create new positions without having to put any new money into the COMEX. So they could pyramid their position up. And that's just helped to lead to this big spike as they just bought into a rising market more and more, and also created a potential for a violent rollover when the party stopped. And that's what happened this morning in New York. We saw a rollover in the price, and then selling begat more selling as traders took profits on their speculative positions and then went into stop loss positions as well. So that creates kind of a violent market reaction, and that's exactly what happened. Let's drill down a little bit further. This is a chart of the COMEX contract for December silver going back 30 days in 1 hour ticks. I've drawn an upper and lower red line channel on this chart to show you where we were before the market really got heated and moved over the trend line this week. Now, that purple arrow shows you where we got the first kind of big correction. But that was when the silver price was already over its channel. And when it corrected, it stayed above the lower support line and then was bought back up and moved higher still. But as we entered into Thursday's trading, we started to see cracks yesterday in the market with sell-offs that started to become repeated, creating kind of a rolling over top. Let's drill down a little bit further to a 5-day chart, which is here. You can see the top formation becomes kind of a shoulder formation with each test probing the same support line, which is that red line that I've drawn in with the vertical arrow at 52.62. Well, once the market broke down below that, we got some selling pressure. Then once we broke the upper trend line, we got a lot more selling pressure because that becomes a support line also. As you can see, the volume, which are those blue bars below, spiked up sharply. The market sold off hard. And those are speculators running for the exits who rode the train higher and now are jumping off the train as fast as they can. Now, off to the right at the very bottom where that little red arrow is, that's $50.26 for the New York December silver contract. That's where the support line lines up for the lower support level today. We got a little under it during part of the sell-off at the worst part when silver got to 49. Where did they get to? 49.66 at the low, but then it was bid back up. I did this chart about an hour before the close, and we moved back up to $50.65 at the close, 40 cents over the support line. So we got kind of back into the middle, the lower part of the channel, which is a good sign, meaning the dip is being bought. And we saw that with our clients as well today. A lot of activity on this dip from our clients, which is another sign that people like this dip and they're buying it. And that's the way we view it. None of the fundamentals here have changed at all. This market still is remarkably desirable compared to sovereign debt, fiat currencies, and the way the world is headed. But we've got a correction, and you've got to roll with it when it happens, and people are taking advantage of it. Let's look at the other three precious metals. Here's a 1-year gold chart, similar pattern, which is taken off very sharply. You know, when this rally started, gold was about 33.36, and we got all the way to 43.28 yesterday on the New York close, almost $1,000 gain for gold in less than 2 months, which is outstanding. And now we've got just a brief correction so far. Gold didn't sell off near as much as silver did today. We still have a 12-month rolling gain of 55%, which is incredibly strong. If we look at a 6-month candlestick chart, we touched right on support today at 4,200 and then moved back over it. Last week, when we saw that little bit of a correction, I drew 3 lower support levels, which really won't come into play right now the way the market's moved over the last week. You really have to look at 4,200, which is where the market held today. And we actually got to a new all-time high intraday today at 43.80, almost $4,400 an ounce. And in the past, when we've seen candlestick wicks punch up like that, that's where the market tells us it wants to go eventually. So I would look to buy the dip here. We closed the day at about 42.50, so we rebounded a bit from the low. And the market, while it did sell off about $100 from yesterday's high, it's still not much considering how much it's gone up in the last 2 months. So the gold market looks really healthy. And the profit-taking correction takes some of the froth out of the market, which is a healthy thing to happen. Here's a 1-year platinum chart. We've seen a platinum sell-off today from about 1723 down to 1600, where we held support. That blue trend line, I put that in yesterday, actually, and we're holding there. We've got a 59% 12-month rolling gain for platinum on a 6-month candlestick chart. We're showing just a little bit more weakness in the candlestick chart, a little breakdown of that trend line, but not much. So platinum still looks good. Remember, platinum is extremely attractive in both Japan and China for jewelry, especially with gold being over $4,000 an ounce. And platinum is scarcer. It's a thinner market, like silver and like palladium compared to gold. So I do like platinum on this dip. We see major support at 1550. And right now we held support today at 1600, with platinum closing the day at about 1609 today. And that brings us to palladium. Palladium's also had a big move higher, but a bigger correction today. On a 12-month rolling basis, it hasn't done quite as much as the other 3 metals with 39% rolling gain. We hit 1655 yesterday, and we sold off all the way down to 1500 today on the New York close. So we had a bigger sell-off in palladium. It's not as widely used in jewelry. It's not used in jewelry because it's brittle and it's not as easy to work with, and it doesn't have quite the same sheen as platinum. On a 6-month candlestick chart, you can see that we've made a nice gain over the last 2 weeks, and we gave up a little bit more of that gain today inordinately compared to silver, platinum, and especially to gold. So I see support for palladium at 1360 and again at about 1500. But I do like palladium in this market as well because it's fundamentally scarcer than platinum. Here's our website. If you'd like to check us out, we have live, transparent, online pricing for the most widely traded, competitively priced modern bullion coins that are, most importantly, easy for you to sell when the time comes. For liquidity purposes, we deal in mainstream, widely traded, competitively priced products. And we're happy to help you with any questions you may have. No question too great or too small. We're happy to answer them all. And if you're still with us, I know you're on our YouTube channel, so thank you for being here. But we'd really love to have you as a subscriber. As you can see, we track these markets pretty closely based on facts, not hype and conjecture. We try to give you timely, factual, and potentially actionable information with our videos. Now, this is not financial advice. We're not authorized to do that, but we can give you our opinions on what we think are going to happen with the markets. And that's what we're doing in a factual and timely basis. So that's our update. Thank you so much for your time and your loyalty and trust that you've placed in us in the last 27 years. Without that trust, we wouldn't have a business, and we're grateful for it every single day. I'm off to a financial conference next week, so I doubt there will be an update next week. We'll look to get you one week after next. So thank you so much for your time and good luck out there.